Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and back in December of last year, I made a video talking about how I saw all the signs of a weakening labor market, not only in the USA, but around the world, all of which hinted that a global economic slowdown was on the way. And I said that despite the fact that the mainstream media was making its best effort to tell us that things were better than ever. And this is an article I showed at the time where low unemployment was being celebrated by the mainstream media. And what I said then was that high inflation and decreasing job vacancies were telling us a different story. And I've pulled up job opening data for the four countries I mentioned back in December here on the screen. And as you can see in this data for the USA, Canada, the UK, and Australia, the number of available job openings has continued to fall off of a cliff since I made that December video. And as a result, we are seeing unemployment at 12-month highs in 3 out of the 4 countries, with the USA's latest reading released this past Friday showing unemployment now at 4.1%, the highest reading actually since November 2021, and Australia, the only country here on the list not at a 12-month high, really just barely below it at 4% versus 4.1% in the previous month, which was a 12-month high tied with January 2024. Now, if you recall that December video, in it I addressed a very big concern for people who are not only holding metals, but also for people who were interested in getting into metals at the time, and that was, if unemployment goes up, won't the prices of gold and silver come down? And the logic many people use to come to that conclusion is, if people are out of work, if people are losing their jobs, they won't be able to buy things like gold and silver. They will have to focus on buying the necessities of life. And because of that, demand for metals will go down and prices will fall with lower demand. And that makes sense on the surface. But in this video, I want to put that logic to the test and revisit some of the data I presented back in December to compare what I said then to what has happened on the backdrop of rising unemployment, so we can get an idea of what direction we're moving in. And once we've covered that, I have a great viewer question for this video on the topic of mining stock performance during periods of interest rate cuts. So let's not waste any time and let's jump right into it. Okay, so back in December, I showed you all this image and I said we were likely at or near the unemployment cycle low, meaning unemployment had already bottomed out and that it would go up in 2024. And that has obviously been the case, as you've already seen. I just showed you that in the data. In addition to that, the analysis we looked at back then showed us the price of gold had increased 5 out of the last 6 times when unemployment moved from its low to its high at an average price increase of 66%. And for silver, price increased 3 out of the last 6 times the unemployment rate moved from being low to high at an average increase of 31%. And what I also said in that video is that increases on silver usually start 2 to 14 months after gold has made its first move up. And with silver at $23 at the time, I said we'd likely start to see silver move in the first half of 2024 as gold had started to move up already in October 2023. Now, moving on to gold and silver performance year to date, clearly the trend we identified in that December video has held true, with gold up nearly 16% since the start of 2024, and silver, which is one of the best performing assets of this year, up 31% so far in 2024. So I'd say we got it right in both cases on the performance prediction side, because despite a deteriorating economy, higher unemployment, and rising debt delinquencies, we are still seeing precious metals go up with more room for them to run. And for those of you who have decided to protect your savings in gold and silver, just in case you lose your job or to supplement your retirement, the purpose of this analysis is to put your mind at ease. And knowing this fact, it's also why I said a couple weeks ago that it's a smart move to have a minimum of 5 ounces of gold and 200 ounces of silver just in case you need it for an emergency, because the data is telling us that metals, especially gold, perform well in emergencies. Now, onto the topic of what is to come and why I am still bullish despite the recent run-ups for gold and silver. The circumstances we are in today are much different than the past periods included in our base analysis. First of all, today we are in an environment where central banks are buying up gold, unlike the 44-year period from 1966 to 2010 when they were dumping gold on the market. And the reason they're buying gold today is because they saw what happened in 2008 in the aftermath of the financial crisis, and they know that if the US economy goes down, not only will it bring the global economy down with it, but it will be accompanied by a massive money printing scheme, just like we saw during the Great Recession, which was sold to us under the name of quantitative easing. But this time, instead of getting quantitative easing or money printing numbers at the same level as we got in 2008 and 2009 and 2010, the numbers are going to be much, much bigger this time. And for countries holding dollars in reserve, that means their holdings, their savings in US dollars will be devalued. And because they know it's coming at some point, it is coming, they are preparing now by purchasing gold today. And this is not a one-off. You can see on the chart that the purchases are getting larger, they are still buying, and they are buying more than at any other period in recent history, as weaponization of the dollar has created additional incentive for some countries to accelerate the pace at which they are buying gold. Now, in the case of silver, there are also additional factors that we need to consider that didn't exist in the early 90s and early 2000s when metals fell out of favor with investors. And that is the fact that there has never been so many uses for silver as there are today in the entire history of mankind. And that means, as I've stated in past videos, upward pressure on the price of silver should remain strong. And yes, I have excluded the 1980 blow-off top from this chart because the causes of that are not in scope for this discussion. I will cover them in a separate video. And no, I'm not ignoring the 2011 blow-off top you can see here on the chart. I understand that was a disappointing pullback for many silver bulls, but if you just objectively step back and look at the trend here, the price of silver has been steadily rising for 20 years after 22 years of relative sideways chop. Again, as uses for silver increase and considering pressures on supply that I have covered in past videos, I stand by my figure of $60 an ounce for silver by 2026. So that's just a little update on where we stand right now with metals as they relate to unemployment and savings protection. And I'd love to know what you thought about that analysis and what you think about my outlook moving into the future. So please let me know in the comments. But now it's time to move on to this video's viewer question. And while you're in the comments, don't be afraid to add your own questions there. I answer one question in every single video I do, and you never know, yours just may be in the next video. And this week's question comes from Farouk. Hello, Mr. Farouk, sending you warm greetings. I am going to guess you are a viewer from Turkey. Thank you very much for your question, sir. And Farouk asked about how miners have performed in periods when interest rates have come down and metals have gone up, and that is a fantastic question. And we're going to start with a little review for those of you who didn't see my last video. Since the year 2000, there have been 3 periods or cycles of interest rate cuts, and metals have flourished during each of these rate cutting cycles. And those periods are marked here on the image, with the first one from 2000 to 2004, the second from 2007 to 2012, and the last one there marked from 2019 to 2022. Now, since the GDX and GDXJ mining ETFs did not launch until 2006 and 2009 respectively, I have pulled up one of the largest mining companies in the world with a long history, and that's Newmont, to gauge how mining stocks did during these periods. And this chart here shows 3-month candles from 2000 to today. And what you can clearly see right at the start is that Newmont performed quite well over those periods when interest rates were coming down, with the stock's price rising by 104% in the first period, then 36% in the second period, and 79% in the third period. And that means that versus gold performance, Newmont did very well, because once you factor in premiums on gold and the dividends that Newmont stock was paying over those time periods, I suppose Newmont may have even slightly outperformed gold over those periods of time. But Farouk, please remember this. As it stands today, miners are extremely undervalued. In fact, the major miner ETF, the GDX, would need to go up another 73% just to reach its all-time high again, and that's in an environment with gold at a nominal all-time high and plenty of room for it to run up in price. In addition to that, I'd venture to say that there is more money to be made in the junior miners and exploration companies right now, because the long bear market we've seen in mining stocks has starved the industry of money they needed to explore and develop new mines. As demand remains strong, and there's no evidence that demand is going to significantly decrease on gold or silver over the coming years, supply coming from developed mines is going to get tight, meaning that any companies that are developing projects are going to become extremely valuable as those already developed projects start to run out of gold and silver. And they will become targets for acquisition by larger mining companies, which will in some cases make the price of those stocks go up 3, 5, or even 10 times higher versus where they are today. Now, I have put together a mining stock portfolio myself. It is available on my Patreon. The link to join my Patreon is in the video description as well as the pinned comment below. And I even made a video about my mining portfolio on Patreon this past Thursday. It's there to watch now for those of you who are interested. And in it, I introduced 2 new stocks I am adding to my portfolio using profits from some big gainers, as well as one position I am selling out of. And as you can see, that portfolio that I put together has outperformed the S&P 500 since I entered mining stocks for the first time in my life, mind you, in late July of last year, and it's grown by 30.6% versus 21.4% on the S&P 500 over that period. So once again, if you're interested in checking that out as well as supporting what I do here, both on YouTube as well as on Patreon, please consider joining me there on Patreon. It's only $14.99 a month, but if you sign up for the whole year, you do get a 10% discount. And as I said, the links to join are below. And with that said, everyone, that's it for this video. I want to thank you all for joining me, for supporting one of the fastest growing YouTube channels in all of precious metals on YouTube. Thank you so much for supporting me and making my dream of becoming a full-time YouTuber a reality. This is officially my first video as a full-time YouTuber and my last one from Dubai. My next video will be from my new home, and I'll reveal that in my next video. But until then, everybody, take care of yourselves and take care of each other. Have a great Sunday, and see you in the next one. Goodbye.